at Endowus. Really excited tonight. We have Financial Horse with us today, a very famous financial blog in Singapore. And we have the founder and guest speaker from Financial Horse joining us. Welcome, Financial Horse.
Hi, Sam. Thanks for having us, and it's really great to be on here today.
Yeah, excited about the topic as well. Markets versus economy. Why markets have rebounded sharply despite grim economic outlook. I know it's a topic that many people have been talking about. So we wanted to address it head on, and who better to join us to talk about it than Financial Horse, who's publishes a lot of articles and great pieces on the economy, financial markets, and even investment as well. So he is a very well-versed investor. Next week, we have Cheng Shi, our personal finance lead, who will be joined by our friends at Five Path Lion. So 2 consecutive weeks with guests without a face. So that's going to be fun as well. It's going to be on the topic of the practical approach to financial freedom. Some disclaimers first, and then just a quick intro about Endowus for those who have joined us for the first time and don't know much about us. But Endowus is a digital wealth advisory platform. It is the first and only digital advisor for CPF. And as a result, it is the only digital platform where you can invest all of your wealth, CPF, SRS, and cash savings, all working towards a common goal of reaching retirement adequacy and important goals in your life. So what we're about is we're trying to help people save and invest better so they can live easier today and live better tomorrow and through to retirement. As I mentioned, we are the first and only digital advisor for CPF, SRS, and cash. And we really focus on a few things and focus on doing them well. It's about access, advice, and cost. So we give access to institutional share class that's exclusive to Endowus. We brought in the first passive investing into CPF, and we stand on the shoulders of giants in investments. We give advice that is strategic and passive in asset allocation as well as investments. So we don't time markets. We're evidence-based and science-based rather than built on any kind of speculation. And we're holistic in our advice for all of your wealth, as I mentioned, CPF, SRS, and cash. And we really try to achieve the lowest cost achievable. So we're all about the fight for fair fees. So no sales charges, no transaction fees, 100% trailer fee rebates, trying to get rid of that trailer fee system in Singapore. And we build stuff that is currency, FX, and tax efficient for Singapore-based investors. So with that, I want to say hi to Financial Horse and thank him for joining us today. And also maybe give an opportunity for him to introduce Financial Horse to our audience today.
Sure, thanks, Sam. And again, thanks for having us here today. So I think the reason why we founded Financial Horse was very simple. A couple of years ago, we were active investors. We were investing in Singapore and international markets. And we found that there wasn't the kind of high quality financial advice tailored for the Singapore audience that really appealed to us. So in the US markets, we have things like Seeking Alpha. We have a ton of high quality personal finance and investing blogs that are designed for US investors. But nothing that really catered towards the Singapore investor that talks about how a Singapore investor should approach asset allocation, should approach investing in this climate. So I think we founded Financial Horse with that kind of idea in mind, that we wanted to provide high quality financial commentary and content as investors, for investors, and really designed for the Singapore investor in mind. So I think in some ways, our core mission does align quite closely with Endowus. So we are really happy to be on here, and we are really excited about what you guys are trying to achieve at Endowus.
That's great to hear. Thank you so much for Financial Horse. And as he mentioned, I think it's really great that we're both aligned. And the reason we started the companies are very similar, because we felt that there was a lot lacking in the investment community and we could improve things, whether it's in financial literacy and education or whether it's in the actual process of investing. So we're very aligned and we're very supportive of each other's endeavors. So very happy that financial host could finally join us. We've been trying for a while, so finally join us and talk about this really exciting topic. So just to set the tone, I did want to engage everybody to participate, and we have a chat going on the YouTube channel. So if you're on any other channel, then our personal finance relationship will translate some questions over. But on the YouTube channel, please be lively. Financial host and I want to make today's session more than our normal session, a bit more interactive, and focus on Q&A and address the questions that investors have. And one of the ways to do it is just kick off with this question. If everybody can maybe put a yes, no, or DM, doesn't matter. Do you think the market is wrong and has gone up too much compared to the underlying economy? Yes, it's gone up too much. No, it's going up more. Going to go up more, or DM, doesn't matter. Markets are efficient. So please answer below with your replies, and we will look at how people have responded and look at your questions as we journey along today. So just as a backdrop, I wanted to give some numbers and data so that people can get a grasp of why we are, doing this session and why we have this topic at hand. We are here because it's not a normal cycle. There's been a shock to the system, massive cases and deaths around the world. And it's very unfortunate that we've seen, it's really sad to see these things, and the impact on the economy and real lives have been tremendous. So it's a shock to the system. So just to warm up, I just want to hear from Financial Horse how he has experienced this cycle, not a cycle, but, the shock of COVID and what we've experienced so far, how he's coped with it, and, what has Financial Horse been doing, and what have you been up to lately in your investing side as well. Just a quick update before we go into the meat of the topic today.
But that's a good question, Sam. And I think it's been a really interesting year so far. So we started out in Jan and Feb, where basically everyone was thinking it's going to be a fantastic year. We had US China trade deal in Jan, and it was shaping up as a classic election year where it looked like Trump was going to pump the economy and the stock market, and everything was looking quite rosy back then. And then suddenly we had this flu coming out of China in January. It spread quickly to the whole world. And then suddenly in March, everything started falling apart. Feds cut all the way to zero in a couple of weeks. And after that, they embarked on unlimited QE, unlimited liquidity. And they even got to a point where they committed to buying corporate bonds, which until now has always been that Rubicon that no Federal Reserve has passed. So it's been a really interesting year. And I think the moment the Fed made that commitment to unlimited QE and corporate bond buying, I think that marked the bottom of this particular short-term cycle. So I think markets have rallied very, very strongly since then. And I think just a couple of days, actually just yesterday, in fact, we were back at all-time highs for the S&P 500, which if you really think about it, it's pretty crazy because we're going through the greatest recession, the greatest global recession since the Great Depression. Inequality is through the roof. You're seeing record unemployment in most developed and emerging markets, and S&P 500 is back where it was in Jan. So it's been pretty crazy so far, and I'm really excited to get your thoughts on where you think we'll be going next. So really looking forward to this conversation, Sam.
Me too. Really exciting to talk about this, but really shocking as well, right? Where we are.
Yeah.
Yeah, so I wanted to kick off with these slides. I mean, just to give some context, this is like a massive drop in economic activity because demand pretty much dropped to zero, right? And it's not just, an Asian issue, it spread to the US and globally. And the US really matters a lot because US consumer spending as a single block of demand is even greater than China. So when it spread to the US, all bets were off, and US is such an important part of it. And we've already seen numbers that show that this COVID recession is the biggest economic drawdown since, the two great wars, the two world wars, and the Great Depression. Other than that, I mean, you look at that blip, which is 2008. And at that time, we were saying that that's a shocker. But it's, this time it's so much worse. And even, the recovery that economists are predicting, and we have three lines here. One is the baseline, pessimistic and optimistic. We have to expect a slow recovery, even in the best case outcome that we see a vaccine and things that recover very quickly. So, we talked about, financial horse, and I've talked about multiple topics across, many days. And one of the things that we talked about was how, unprecedented the response has been from the governments, both monetary and fiscal. So I just wanted to touch on the fiscal stimulus, and especially since we're in Singapore, this is the US, and we've seen unprecedented massive fiscal stimulus. But what about Singapore, financial horse? And what are your thoughts on the Singapore budget and the recent announcements of further fiscal stimulus?
Yeah, Sam, I actually thought you described it really well when you said it's an unprecedented fiscal stimulus.
Hmm.
And I think that's really what we are seeing out of Singapore as well. So I think Singapore has gone since independence without really touching on our reserves. We went through the Asian financial crisis, we went through 2008 without drawing down on reserves. But this time around, ever since March, we've gone about 100 billion, which is about maybe 20% of our GDP. And a bulk of that actually came or was financed via drawdown on reserves. So I think that really gives you an idea of how unprecedented the Singapore government views this particular crisis. And I, I guess one point I wanted to touch on was that we've had unprecedented crisis up to now, but going forward, let's say the next 6 months, 12 months, are we going to see the same level of fiscal stimulus coming out of global governments? Because just take Singapore, for example, right? So we had 20% of GDP from March until maybe August. We had a job support scheme that covered up to 75% of salaries. And then for the new budget that came out on Monday, it was 8 billion. And a lot of the fiscal stimulus, JSS, it was cut by a certain extent from where we were before this. And if we look at the US at the same time, the US, they're still trying to work out a deal between the Democrats and the Republicans to extend unemployment benefits. So I think while we've had unprecedented fiscal stimulus from March until now, I suspect the route going forward may actually be a lot harder than the route from March to now, because that whole feeling of this being an unprecedented crisis, a lot of that is gone, and now it's moving into a longer grind, more of a marathon rather than a sprint. And I think people are really starting to wake up and think about the implications of what they're doing. So
Absolutely.
yeah.
Yeah, great points. I think the overarching view is that, fiscal stimulus, and this is unprecedented because if you think about what happened in 2008 and the global financial crisis, we saw a massive monetary stimulus and quantitative easing, which we'll get to. And this time has been even bigger response monetarily. But because of the nature of the crisis, where suddenly we had all economic activity ground to a stop, ground to a halt, and we saw economic demand suddenly drop. I think the response of the government in fiscal stimulus is really a stopgap measure to, to really fill that gap that the demand drop, sudden demand drop had created. So in a way, fiscal stimulus is always, in my view, something that is necessary to, fill the gap of weak demand or sudden drop in demand due to, 9/11 or, something like a COVID. And 2008, actually, we didn't see the kind of fiscal stimulus that, many people hoped and expected. And so this chart already shows that the US is, even without the new stuff coming out, is already at unprecedented levels. And you, financial hosts, highlighted very clearly as well. Singapore has never done this before. And I think it just goes to the nature of the crisis that we were in. And you're right that there has to be pulling back of fiscal stimulus because we cannot continue to spend. But hopefully there is a multiplier effect to that fiscal stimulus, especially when it's combined with monetary stimulus. And then the other thing is that, as we saw in the previous chart, of the demand actually coming back. So what the government did was to fill the gap, but hopefully private sector, corporates and individuals will fill the gap as the economy recovers, or if the COVID situation improves, or a vaccine is created. I think that's kind of the scenario that most people would expect. Does that kind of make sense? Um,
Yeah, makes sense.
yeah. And so yeah, go ahead.
No, actually, one point that I wanted to add on was that point you raised about the multiplier effect. So
Mm,
I do agree with you that so far, or actually since 2008, the response was primarily via monetary policy. And this time round, it was monetary and then it moved into fiscal very quickly. But at the same time, money velocity has been going down, or rather, it has gone down since the 2000s. And it's unfortunately we don't have any charts here, but if you pull up the M2 money velocity charts for the US,
mm,
it shows a drastic decline in money velocity since the year 2000, and
yeah.
it's not changed despite the amount of money supply that's gone up. So I guess practically what this means is that even though the US and banks around the world are creating so much money, that money is just getting stuck in financial assets. It's not
Mm,
circulating in the real economy. So people are taking that easy liquidity, they're using it to buy Facebook, Google. They're not using that to go to a restaurant and spend on food. And I think that's really going to be the big problem that we'll see in the next 2 to 3 years, where governments really need to find a way to jumpstart demand, consumer demand, and
mm.
instead of simply growth in financial assets. So
Yeah, that's a great point. I would add two things to that because one of the reasons why money velocity has fallen, one is, the ineffectiveness of more debt and more leverage, right? So when you're extremely leveraged, it's very inefficient, and so the money velocity naturally falls. But the other reason I think, especially in the U.S. and globally as well, is regulations. So a lot of banks and financial institutions now have to shore up their capital and maintain a much higher level of regulatory capital, which reduces the leverage and the volatility, velocity of money in the system. And so it's more about, like, you have to throw more money to get the money to work for you. And so it's a declining, utility, marginal efficiency that you see when you throw more money at problems. So yeah, it's very real. I think it's a major problem, and raises a lot of concerns about the level of growth that we're going to see in the future, which is this chart that we are going to see a recovery. Clearly, we will see a recovery in any kind of scenario, but what is that shape of the recovery? And so, yeah, it's good points. Um, any other thoughts on the economy, the budget deficit, before we move on?
nothing for now. I think let's move on in the
Okay.
slides. I'm sure we'll come
Yeah.
back to these topics later.
Yes. And we
Yeah.
have some monetary stimulus and market charts that we can show.
Yeah, they all tie back to the same underlying problems.
Precisely. And this is interesting because we compared, like, I borrowed this from Bridgewater, by the way. Uh, and Great Depression, global financial crisis, and COVID are the three big, worst case scenarios that we've seen. And, if the new stimulus in the US is passed, then it will actually surpass, or be at the similar level as the Great Depression. We're already way above 2008. And this great chart shows you the impact of the economy falling, and then what the governments have done, which is the orange bar. So the blue bar is how much the natural economic drawdown was as a result of demand falling. What the stimulus has done so far to negate some of that fall in demand, and what is the net effect of that economic growth, which is the red dot. So you see that it's actually not just the US. Across every country, you can see the impact of slowdown in growth, the massive stimulus that we've seen, and yet growth is so negative across all countries. And rate cuts. What can we say? Historically, massive globally coordinated interest rates. So we've fallen below the previous low of 2008. bond yields as a result. Financial host just mentioned how the Fed is buying corporate bonds as well, but massive buying across the curve, across different risk levels in fixed income markets. And so we're hitting new lows. And quantitative easing projected for this year is already above 2008 levels, but will reach new scales that we've never seen before. But the interesting thing I wanted to show was that we've seen this before. The same scenario is playing out in the Great Depression, global financial crisis, and the COVID situation. And the problem is that because we've seen it before, everybody seems to be reacting in the same way. And the same way it's played out, it's actually when the Fed started printing money, that's when actually the market kind of bottomed. And from that bottom that was created largely by the Fed, you've seen the markets actually start to recover. And this time has been no different. And that's been shocking because we have just seen the third largest equity drawdown in history. And it ended up being the fastest bear market and the fastest market recovery in history. So we'll pause here and hear from Financial Horse, just thoughts about markets in general, how you're seeing markets. I mean, this is surprising to all of us, but is it surprising to you, first of all? And, what are your thoughts about markets going forward?
Yeah, thanks, Sam. I was just thinking back to that comment you made where once the Feds went into unlimited printing, once government started printing money, that marked the bottom. And I think you're right that if you look at this all throughout history, the Great Depression in '08 and Asian financial crisis, all throughout history, even in the 1970s stagflationary period, whenever the Federal Reserve embarked on that money printing path, that usually marks the bottom. And I think the only difference this time was that it was so quick. So like in the Great Depression, it started in 1929 and the Feds only started printing in 1933. So there was a whole 3 to 4 year period where the economy just went through horrible pain.
Yeah, this is actually the chart, 43 months exactly.
Yeah.
From the stock market crash to
Exactly.
QE starting in the Great Depression. Yeah.
And this time around, it just took 1 to 2 months of market declines and we saw unlimited money printing. But I guess the logical question then is that there's no free lunch in this world, right? Everything you do has a natural and logical consequence on the world. This kind of unprecedented money printing this early on in a crisis, we've never seen it before throughout history. So I guess the question then is, what do we see next? Do we see a sustainable economic recovery? Do we see a deflationary phase? Or do we see an inflationary phase? And I'm actually quite curious to get your thoughts on this.
Yeah, we have some slides on inflation, and I was going to touch on that later. But maybe we can talk about the markets and we'll touch on inflation later on and the effects of QE. I think I think most people right now are when we saw the market rebound and rise quite significantly from the lows. Initially, I think we were climbing a wall of worry. People were saying that, oh, the economy is so bad. How can this be? Markets rebounding, it's going to go back down again. That was the common view that most people had, I think, in the market. And I think that some people didn't fully understand the scale of the stimulus that had come out already by the Fed, especially when it came to the disruptions in the fixed income and bond markets. No, so it had a positive impact on equity markets, but the policy itself is actually really focused on the real economy, staving off bankruptcy, and giving lower cost of funding so that companies can survive and individuals can continue to service their mortgages, etc. So, the Fed's real primary motivation is not the stock market. It really is. I mean, politically, many people talk about that, but I think it really is focused on the real economy and trying to, prevent the disaster scenarios of 2008, where we let banks go and we let companies go, and that had negative spiral effect on demand and supply. And so I think they were just trying to prevent that because of the unique circumstances. And to that extent, I think they were largely successful. And so the stimulus impact is real. And if we think about markets and what markets really are, it's demand and supply, right? So there is demand side, which is people buying stocks in the case of stock market. Same thing for bond markets and any other markets that has demand and supply. And then you look at the amount of supply coming out, which is people who are selling in the market, or new issuances, like rights issues or IPOs. And then the demand side is the money that is being used to invest. And in the global market, I guess, you can think about like just regular people saving from their income and investing in stock markets on a regular savings plan. You can think about pension programs that have a regular savings and then they invest, or insurance companies that have regular premiums that they invest in the markets. So there is this natural demand for stocks, which is a growth asset class. And therefore, that's what drives the market's kind of long-term positive skew and the rising markets that we see, because there is a natural greater demand for good companies, equities and growth asset classes over the long term, because there is an expansion of money and there is a resulting expansion of demand. So demand does outweigh supply, I think, overall. And especially when you supply the market with a very big stimulus, monetary stimulus, and the pool of money increases, I think that liquidity effect does exist in markets. And it's not just stock markets, but it's all asset classes, I think.
Yeah, I actually do agree with you that the Federal Reserve did what they had to do to keep the
Mm,
economy going. Let's say they hadn't done this, I think we'll be in a world of pain now.
mm,
It would be way worse. It would probably look a lot like the Great Depression had the Federal Reserve not done what they did. The problem was that in doing what they did to save the entire economy, I think there were certain consequences for financial markets that we've started
mm,
to see in like what you said, the fastest rally from this bear market ever.
mm,
And I it's interesting, you see, because I was just looking at Microsoft yesterday. Microsoft,
mm,
they're pulling in revenues of about maybe 140 billion and they are valued at 1.6 trillion. That puts them at about 12 times price to revenue. So to really put that in perspective, you have to take 12 years worth of Microsoft's revenue, even without setting off expenses, and that buys you the company. That's, to me, that's just starting to look on the pricey side, and that's we are probably not at the .com valuations yet, but it looks like if this keeps up, we may actually get there. So it's
mm.
interesting that we went from Great Depression in March to something like the 1999 .com boom in the span of 6 months. And I guess again the question is, where do we go from here? So
Yeah,
yeah,
that's the
and
big question, right? We
exactly,
have a couple of
exactly.
questions.
Yeah.
One is from Jackie Lee saying, "Can Fed keep this up forever?" Um, oops, sorry. And then there is another question that is from WT. Was the Fed able to print money during the Great Depression, 1930s, with gold backed USD? Um, and multiple questions about that. And so, just what are your thoughts about the Fed, and can they keep this up? And if you have any thoughts.
Well, on the second question in particular, I think the answer is that yes, the Fed did the exact same thing back in 1933, and they did the
Mhm,
same thing again in World War II. So a lot of people looked at that and they drew a comparison with March, which is why when the Feds did what they did in March, a lot of people started buying the dip, and that's what led us to here. So I guess the short answer is that the Fed's ability to print money is theoretically unlimited, and they can, and historically they've shown that they will do something like this in the event of a unprecedented crisis like what we are seeing today.
yeah, I agree. And just to let you know, WT, that the Fed did the US dollar was on the gold standard, but they actually came off the gold standard. I think it was in 1933, and they followed the UK, who had actually removed themselves from the gold standard. And that's part of the reason why they were able to do QE and stimulate through money supply in a much more aggressive way. And that was what led to the recovery in the markets. And once again, the most powerful tool is when you combine monetary policy and fiscal policy together, and that's when really the impact, is big in trying in stimulating the economy and creating a virtuous cycle. And to Jackie's question, I mean, the Fed can technically keep this up forever. I mean, they can technically print money. They can become, a banana republic with runaway inflation, like some, third world country eventually. But what's preventing that is because, everybody still trusts the Fed, that they'll be good for their money, that they will eventually pay back the borrowings that the Treasury is borrowing. And you're actually printing money to buy the treasury, so you're actually circulating the money yourself. So it's something that you can actually keep going. But having said that, what it leads to is a devaluing of the value of your currency, and it's something that financials and I would also touch upon. But that's the risk, and it destabilizes your status as the reserve currency. But having said that, I think what we saw since 2008 is that they've always managed it quite well. They've drawn back the balance sheet when it was necessary, and in 2018 they did raise interest rates several times because they felt that inflation was coming back. And I think that's the biggest question that we face, right? Financial force is that, going forward, how does this play out? And, there is always a cycle, even if it's from a very high level of interest rates, or even if we're at zero, the Fed does move in cycles. And although we had an extended period of almost zero interest rates, they did start tightening when inflation came back. So this is the big question that you asked earlier, financial host, about the Fed cycle and inflation. Uh, so there is a correlation between QE and inflation, but it's very limited because we don't have historical data. In previous cycles of QE, we did see inflation coming back, but it was really correlated to the economic recovery. And there is, a lot of slack in the economy, and you have to have very tight conditions before inflation really comes back. And that's what we saw in 2018 was that, unemployment was reaching really low levels. And as a result, the concerns about inflation rose quite dramatically. So I think, maybe we can talk a little bit, pause here again and talk about, what is your outlook and thoughts about, inflation and how this plays out in the US, which has a huge implication for the global economy and global markets.
Yeah, that's a tough question.
But just thoughts about, do you think inflation is on the way back? Or, I mean, there's a debate still going on, right? Because people think, oh, this is like deflationary still, disinflationary, because there's so much surplus capacity, demand is so weak. There's no pricing power by manufacturers or suppliers.
Yeah.
So how can inflation come back? Unemployment is so high. So that's one part of the group. And the other side is actually monetarists. So it's just inflation and interest rates is a function of money. It's a price of money. Inflation is the cost of money. So basically, if you're a monetarist, then you think that inflation will come back because there's so much liquidity. Um, so I don't know which side you fall on.
Yeah, so I was actually reading this article yesterday that framed the question not in terms of inflation, but more in terms of inequality. So the problem that we have currently globally is that the older generations, the baby boomers who own significant amounts of financial assets, they own houses, they own stocks, they own companies. These financial assets, they've benefited very strongly from 10, 20 years of QE where interest rates were kept artificially depressed. So all this money flooded into financial assets, and the baby boomers, the older generation, they got really rich. But the younger generation, the millennials, the guys who don't actually have any financial assets, they are exchanging time for money. They're basically working for someone. These guys, on the other hand, they've actually been in huge trouble because financial assets have gone up in price by so much. But at the same time, wage inflation has barely even kept up with inflationary pressures. So the fresh graduate now isn't earning significantly more than he was as a fresh graduate maybe 10 years ago. At the same time, the price of a house in New York or price of a house in Singapore has actually gone up pretty significantly since, as has most of the stock market. So going forward, I guess there are two ways you can resolve this crisis, right? So one is that you reduce inequality. So you find a way to bring the price of financial assets down and you raise the price of labor. So the guy now, the millennial now earns more from his day job, and the house of price, as measured by his yearly wages, comes down. Or you have the other option where you continue on the path that we've been the past 20 years, which is we continue raising inequality. We continue bringing interest rates down. We continue pumping in liquidity, and the baby boomers get richer and the millennials get poorer and poorer as a portion of the overall economy. So my personal view is that short term, we may still go into a deflationary path, but I think longer term, the only sustainable way out of this crisis has to be inflationary. So I think that longer term, most governments, central banks around the world, they are eventually going to take the easier way out, which is to go down inflationary path. They're going to print money. They're going to stimulate the economy. This will prove to be inflationary for the economy. So there will be increasing wage pressures. Cost of products will go up. Cost of goods and services will go up. And yeah, I personally, I think in the short term, it may be deflationary, but say mid to longer term, I genuinely think the only sustainable way out of this COVID crisis is going to be inflationary. And just take a look at the amount of deficits that the US is running. So they are maybe at 10 trillion right now. And I think that if you're going to run a deflationary path, there is no feasible way the US will be able to repay that part of debt. But rather, the more logical way, or rather the easier way to do it, would be to run an inflationary policy where, let's say, if you can get inflation to 3% and the long-term cost of debt is 1 or 2%, you let it run for 10 years, and the amount of debt as a percentage of your GDP actually drops pretty significantly. That's very similar to what they did in the 1950s to 1970s era after World War II, and that actually got rid of a huge chunk of the deficit that was accumulated during the 1930s to 1940s period.
Yeah, good points. I did want to take the opportunity to maybe clarify a few things because we have some questions about, QE has caused asset price inflation already. As the Fed print money to save the market, does it mean the market will keep going up? Inflation needs two things to happen: money printing and money velocity. And how does the unlimited printing of money affect currency? We have a lot of different questions, but as a result, I did want to clarify two things. One is the concept of inflation. When we talk about inflation in the normal sense, it's consumer price index, right? Or the GDP deflator is another indicator of inflation. And it's really about prices of the cost of living. And that's where I think most people focus on inflation. But to Jackie's point about asset price inflation, that's the only place where we have seen inflation. And that's going back to the title of the event today. It's the markets versus the economy, because the economy is not seeing inflation. And the wage inflation, when we talk about inequality, as Financial Horse just mentioned, it really is the gap between the market and the economy. Because the markets have been really good, but the economy is not. And asset price inflation is high and great because whether it's real estate or whether it's fixed income or equities or private equity or venture capital, any asset class or even gold or other things have actually done really well during a period when the economy has been very poor. So CPI is low, but asset inflation is high. That's what we're fundamentally talking about. And that's the gap between the economy and the markets. And so it's very real. Inequality and inflation is just a reflection of the other same side of the different sides of the same coin, sorry. The other point I wanted to make was, people seem to be mixing up stimulus, which is monetary, which is printing money, versus fiscal stimulus, and fiscal stimulus is the budget. So how you fund the budget, as Financial Horse said earlier, is you can actually use money that has been reserved and saved up, like in the case of Singapore. So Singapore is not printing money to spend, whereas the US is actually printing money, issuing debt in the form of treasuries, buying it through the Fed. So the Treasury issues debt, the Fed buys the treasuries, and is funding the fiscal deficit that exists. And that is going to individuals and companies, and they will spend to stimulate demand in the economy. So it's a virtuous cycle that you would use a Keynesian kind of model of fiscal stimulus, but backed by monetary stimulus to fund that fiscal budget deficit. So I think just to clarify those things so that people can have a better framework to understand it. And I think we talked about inflation, but it naturally leads to the current question of currency, right? FH. Can I call you FH, financial horse?
Sorry?
I called you FH, financial, short for financial horse. Can I call you FH?
FH is good.
So this is a chart of the shape of recovery. It really does depend on how the shape of the recovery plays out. I mean, virus peaks, vaccine is discovered or developed, and things normalize at a much faster rate. Then the concerns about inflation will be much higher. But if we see a scenario where things actually stay, bad, and vaccine is here or is not readily available, and so the demand recovers much slower, then I think the inflationary concerns may not be as high as expected. And so that has a knock-on effect on currencies and the impact of, impact to the dollar, which also has an impact to the rest of the world. So on this issue, do you have any views, FH, on currencies, the US dollar or even Sing dollars, and, in general?
Well, my longer term view on the US dollar that it's probably going to have to go down from here. I think the USD is the reserve currency. It determines financial liquidity conditions for the whole world. So a stronger USD is going to be bad for the global economy. A weaker USD is great for the global economy. So I think mid to longer term, the Federal Reserve and the US government needs to do everything in its power to ensure that the USD goes down from here. And I think they'll probably succeed. What I'm not so sure is where the USD goes in the short term. Because short term, I think the USD has fallen very quickly and very significantly from its March peak. And I'm not so sure whether the USD is looking a bit oversold at the moment. We are seeing a lot of emerging market currencies start to play out in Brazil, in Turkey in particular. And I think short term, I think there's still the potential that the USD goes up before it then embarks on a longer term decline. But I don't know, Sam, where do you think the USD is going short term?
Yeah, I mean, we're not in the business of forecasting, just a caveat to begin with. But, we can have thoughtful discussion about, how we see the world. And I do see that, there's a dollar smile, as we call it. My previous colleague at Morgan Stanley, called Stephen Lee Jen, came up with the term the dollar smile. So the US dollar strengthens during a period of economic crisis or some kind of systematic risk. And there's a flight to safety, and the dollar strengthens as a result, which is what we saw in March, what we saw in 2008. The initial response may be negative if the genesis of the crisis is in the US, but the dollar will still strengthen because people will have a flight to quality effect. The other time that the dollar strengthens, if the US economy is great, it's like overheating and burning, then the dollar actually strengthens quite well. But in between is when the dollar weakens. And we're kind of seeing that as a crisis, worst scenario abated. I think we are seeing a period where the US dollar is a little bit softer. But what's exacerbated the whole US dollar weakness is the systemic problem, the systematic long-term concerns about the viability of the US dollar as a reserve currency in the global economy. and the value of the dollar is devalued because of the money printing and quantitative easing that has happened. So my view on a lot of these inverse correlation to US dollar. So, the US dollar versus the Japanese yen or Swiss franc. So within the currency circle, you're seeing that people are shifting their allocation away from US into, even euro a little bit, Japanese yen, Sing dollars, and Swiss francs, and like safe haven currencies that are very strong, but look better and are more stable, have a much better balance sheet than the US. So that's one trade. So it's a trade-off within the currency space. Second one is gold. So we'll talk about gold. It's a very hot topic. And so gold is another one that people shift to because gold is an anti-dollar play. So there's a high inverse correlation, negative correlation between gold and US dollars, especially because gold is priced in US dollars. So people forget that gold is a US dollar priced commodity. And as a result, when the dollar strengthens, gold weakens. And when it weakens, then gold strengthens. And the systematic view that US dollar's value is falling, it will lose its reserve currency status. And maybe China's not ready, other currencies, euro doesn't look great, so we'll buy gold. So that's the other trade that goes on. And then the third one is Bitcoin. And other like cryptocurrencies or alternatives, which are a real bet against the US dollar or any kind of fiat currencies. So fiat currency means paper money. So you are betting against systematic fiat currencies and looking for digital alternatives like Bitcoin, which has done well. So Bitcoin, gold, other currency pair trades like the Japanese yen and Swiss franc and Sing dollars are all, I think, a symptom of the problem that the US dollar faces long term. So my personal view is actually I'm kind of like a little bit in reverse to you, financial host, is that short term, I think the US dollar will continue to weaken. And it depends on the shape of the recovery. But if we do see a strong recovery, then what is likely to happen is that we will have concerns about inflation. And when that happens, then there will be concerns about the Fed maybe tightening liquidity at the margin. It may not be like a drastic liquidity reduction. We may not see drastic interest rate hikes like 2018, but I think there will be concerns in the market. And that will be enough to maybe stem the tide of loss of the US dollar. And maybe, if they do embark on tightening and higher interest rates, then the rate differential to the world, rest of the world, is going to play in US dollar's favor. Unless US dollar goes to negative, we're in deflation, things are bad, and we go to negative yield because the Fed continues to stimulate and print money, then the dollar will do badly. But if they reverse course because the economy is better, vaccine is being found, then that's a scenario where I can see the US dollar actually strengthen medium term. So it really depends on the shape of the recovery, if that makes sense. Yep. And it goes to, do you have something to add, financial host?
No, I actually do agree with you that a lot sort of depends on the shape of the COVID recovery, which, to be honest, right now, there's still a huge range of possibilities that can play out, right? So it can be a situation where the virus mutates and it gets worse. It can be a situation where we have a significant second peak as we move into the winter months. It can also be a case where we get a vaccine maybe by Q4, Q1, and we move into mass production by early next year. So I think where we are right now, there's a huge range of possibilities that will start to narrow over the next few months, and that will give us a lot more clarity on the shape of the recovery, as you rightly pointed out. And I think how this recovery is going to play out is going to have a big impact on how fiscal and monetary policy looks like going forward and on the eventual path of economic recovery. But I guess another point I wanted to add was that I think there was a chart earlier that showed the interest rates going back all the way to 1930s. And it shows that there's been a long-term cycle in interest rates. So interest rates were rising from 1940s all the way to 1980s. And then they peaked in the 1980s at about 12 to 15%. Yeah.
This one. Yeah.
And then from the 1980s, it's been declined for the next 40 years until 2020. And I think we've just been in a secular bull market for bonds where interest rates have been going down for the past 40 years. And at some point in future, that will have to end, and we will need to basically start on a new longer term debt cycle. So in some ways, as drastic as COVID-19 was, I think it merely accelerated the end of this debt cycle. And so in some ways, this was always going to happen. The only thing that changed was that COVID-19 accelerated the cycle. So that's probably what I wanted to add to your commentary.
Yeah, that's great. Thank you. And I just wanted to touch on that interest rate cycle because if you look at the global, aggregate index, increasingly more percentage of bonds are yielding below 1%. So this is, 1% and below is almost 80% of the global market. But we're clearly seeing much more negative interest rates. Among the Bloomberg Global Aggregate Index, I think up to 30 or 40% of the index is now in countries like Europe where there is negative interest rates. But one thing I think people misunderstand is that, even in negative interest rate, you can actually make money from bonds, right? Because technically yields are an inverse of the price of bonds. So if the interest rate continues to fall, it's the direction of the interest rate that is actually more important for investors of bonds. And that's why European returns from bonds have not actually been that bad. So this is just nominal excess returns from bonds indexed, and what the three European countries have shown. Obviously, it's volatile, but you can still make money from bonds. But the one that I actually wanted to touch upon was gold, because I know you have a view on gold, and it's important to talk about this topic. And there's a question on not only gold, but also just real assets, whether we should be looking at real assets and investing because of the concerns about inflation and, devaluing of currencies. Is owning physical assets such as property and gold a hedge against inflation, which clearly it would be. But is that a better investment than risk assets is, I think, the real question that we need to ask ourselves. And also, there's some points and discussions on the chat room about, how the Yang Mo Kyo BTO HTB is 725,000 last night. That it's tied into the same question. So I was wondering if you had some thoughts about gold and, real assets, especially long term, if you have an inflation concern.
Yeah. Well, Sam, I think I may have different views from you on this, but I do belong in the inflationary camp. So I think this crisis is going to play out inflationary in the mid to long term. So I do think that real and hard assets are going to be outperformers, at least in the mid to longer term. And within real to hard assets, okay, so the classic playbook to hedge against inflation is that you long equities, you long gold, and you long real estate. So I think these three are the classic asset classes that hedge against inflation. And I think really going forward, that's probably the playbook that I personally would want to be running for my own portfolio. I do want to be exposed to equities. And I think within equities, you want to really focus on equities with pricing power. That has to be the key, because I think in this market, there are going to be companies who are just not going to do so well. It's possible to see guys in the hospitality or tourism industries that continue to struggle for the next 1 or 2 years at least. So I think even within equities, it's important to pick right. And I also like gold. I'm pretty bullish on gold, silver, Bitcoin. This kind of hard assets that, like you said, hedge against a currency debasement or currency deflation. I do think that midterm, uh, with all that stimulus and money printing going on, it's just going to debase fiat currency, and real assets like gold, silver, Bitcoin are going to benefit. And the last one that I really like is real estate as well, physical real estate. So this is it's probably the most classic hedge against inflation. People have been doing this for centuries. There's when you own a piece of real estate, a physical real estate, regardless of how much money is being printed, you still own that building right there. So I think one caveat to real estate though is that COVID-19 has actually had a pretty transformational impact on real estate. So I can see that I believe that certain industries, maybe like hospitality, perhaps retail, perhaps offices, commercial, they may not recover the same way. I also see that I believe that certain cities, maybe Hong Kong, maybe Manhattan in the short term, they are also not going to bounce back so quickly. So I think with real estate, you do want to be careful to pick real estate in the right asset class and real estate in the right geography and the right cities. So those are the points that I would want to point out for these three asset classes.
Yeah, great points, great points. I actually agree with a lot of things that you said. I don't know why you said we would disagree. So, great points. And I just want to add before I do, I would like to encourage everybody to ask questions on the chat room, because I think we're running out of questions. We're running out of time as well, but we'd love to address more questions from you. So please feel free to add questions into the chat room so we can deal with that after this comment. I would add also that I think there is a lot of uncertainty still. And, I think it's important to frame your view on certain scenarios that will play out. So if there is an inflationary scenario, then this is what may happen, and this is what are the kind of asset classes that will do well. But if that doesn't happen, because it may not, and human beings, as we know, FH, is that we are terrible at predicting the future. We actually cannot do it, and we cannot do it consistently and systematically. So, we don't know what will happen. And if we are in a further deflationary scenario, things may play out in a very different way. Also, I showed you a scenario where actually you do see inflation, but actually interest rates go up and the Fed tightens and the dollar strengthens. And some of these actually systematic concerns that people have, they will understand that the US is not in chronic decline. Maybe the reserve currency status remains. China is not going to take over immediately. And therefore, in that scenario, actually, US does relatively better. And, as a result, gold may actually see a correction. Maybe, Bitcoin doesn't do as well and real estate prices don't come back. But so those are the kind of things that we need to really understand. Take your thoughts to its logical conclusion. So don't just do first derivative thought process because that's too simplistic. Many times there is multiple like onions, multiple layers of thought process that goes into the final conclusion that comes out, and that's why investing is so hard because it's the markets are unpredictable, and the levers or the factors that drive markets are also very unpredictable. The only thing I would add to that scenario of inflation where gold and physical assets do well, I would say that, you pointed out a great point, which is, most people look at gold or real estate, but they forget that equities is actually an inflation hedge asset class. So it normally does relatively well, unless you have runaway inflation, then all bets are off anyway. So equities is actually a decent performer, quite a good performer in the case of a mild and to strong inflationary environment. Especially if you have this loose monetary condition, then the demand for stocks and equities will remain high. So people talk about how gold has done so well this year, but equities from the low has beaten gold, for example, on the way up. So equities is a high beta play on recovery, but also a high beta play on inflation. So that's the first thing I would say, is that equities is actually quite good. And it may provide benefits because of the uncertainty we face. It may be better to be in liquid assets versus illiquid assets. So real estate and private equity and venture capital, a lot of different things are illiquid assets. And they're great because long term, because it's illiquid, the whole mantra, you don't check your house price every day, like unlike stocks. So you actually just locked in, and therefore you ride the long-term wave of asset price inflation for housing and illiquid assets, private equity, which is buying businesses. But in liquid markets, you are actually prone to the temptation and behavioral habits of selling too early or trading too much. So I think it's important to know the difference of asset class and the risks that you have. Illiquidity risk is a risk. And because of the uncertainty, I actually prefer being in liquid assets, which is, equities and maybe gold. So those are the things that I would say. And I would also point out, as I said, there is a scenario where gold doesn't do well. So please be aware of it. Um, and then the final point is, sorry, I think that's enough for that point. But there are some questions that we wanted to answer about the U.S. election. Will the U.S. election change the course of the U.S.-China trade war and restart the economic recovery? So I know we're not political experts, but maybe we can talk briefly about that. I'm actually quite well versed in the U.S. Politics and how that impacts markets over long periods. But do you have any thoughts on this, FH? And do you think it will actually impact markets and market direction?
Well, the way I see it, okay, actually, I'm really keen to hear your thoughts, but maybe I'll
Okay.
share
But
mine.
also maybe since you've studied in China and lived there for a bit, so just
Yeah.
maybe your thoughts about China and just, maybe we could tie that in a little bit. And we can just share openly about
I,
our
I th-
views.
let okay on the trade war in particular, I think whoever wins, Trump or Biden, is just going to play out as a longer term conflict between the US and China. So I think
Mm,
if Biden wins, the trade war, the US China conflict is not going to go away overnight. So there's this really good book by Prof. Graham Allison on the Thucydides trap, which
mhm,
states that all throughout history, whenever you have a rising power that rises to challenge the existing status quo, those two powers will always end up in a conflict. Sometimes it ends up in a hot war, but it always ends up in a cold war slash conflict style scenario. So I think
mm,
Trump, in some ways, he was the catalyst that sparked this broader movement. But now that the US is on this collision path with China, I don't think the November elections are going to change that. So regardless of who wins,
mm,
US China conflict is going to play out for the rest of this century until we have a clear winner, or we or until it's clear who's going to be the dominant power. On
mm.
financial markets, there was actually this report by, I think, JP Morgan recently, where they actually forecast an 80% chance of Biden winning, which I thought, okay, was a bit high.
Wow, it's
But
a bit high.
yeah,
Okay.
yeah, it's probably a bit high. I would put it more at 50-50. But what they actually said was that the market consensus view is that Biden would be negative for stocks because Trump's all about payroll tax cuts. It's all about easy liquidity and pumping money in, whereas Democrats historically they're a bit more conservative. But JP Morgan's view was actually that they see Biden as being good for stocks. They think a lot of policies that he will enact, of a lot of the path that the Democrats are on currently will also be good, and it will continue to stimulate the economy. So what they were trying to say was that even if Biden wins, it's probably pretty bullish for stocks. And I guess in some ways that could be true because unfortunately Biden hasn't really come out and shared his views on what he's going to do if he wins. So there's not much to go on, but
Mm.
I'll definitely be watching the next few months closely to to see what economic policies he's going to offer going forward. Because I do think there's a real chance that Biden actually wins this.
Yeah, I think it's a consensus that Biden has a much higher chance. But elections in any democratic country, especially a country like US, where it's not one man, one vote, it's an electoral college. And so it's not as clear cut. And so it's always a 51 versus 49 kind of game, even though it looks that way. And I think, the fact that the equity markets and the stimulus is working is actually playing in the incumbent's favor. That he's able to tout that the markets have come back and things are great. But what I think Trump maybe misses is the point that you pointed out, FH, is that the inequality in the US is reaching really extreme levels. And this rebound is actually exacerbating the situation because I saw a study by Fidelity that showed that of their clients, 20% of clients, I think, sold all their equity position at the bottom during February to April. And among them, I think 60s to 70-year-olds sold the most, and they had a higher percentage, which is very unfortunate and sad. But the reality is that the average American does not hold a lot of equities. And it's really the white collar and professionals and richer people and owners of businesses who are just making a killing. Elon Musk has become the fourth richest person, and the top guys are all like making so much money. Bezos and Bill Gates, the top three. So I think that gap is widening, and I think the masses are very unhappy, and that will have an impact on the votes if they turn out in a big way. But the studies, if we look at just the studies that show what happens after U.S. general election, presidential election, is that the market tends to do actually quite well, and that's the nature of markets because the market doesn't like uncertainty. And so when there is uncertainty about who is going to win, that's not good. If there's uncertainty about what the policies that Biden and Harris bring in is uncertain, then it's not good. I think if we had a Bernie Sanders who was running and he had a real chance of winning, then that's really bad. But I think a Biden Harris is not a bad scenario where people will suddenly dump stocks just because they came into power. So I think that's the first point I have to make. The second thing is that actually, with regards to the US-China trade war and the impact, there is a big trend that people may have missed is that the US has moved to self-sufficiency. So the first was food self-sufficiency, which they have accomplished. They're a net exporter of food, right? And then oil. So they moved away from dependency of oil. They become self-sufficient. And the other thing that within the Trump administration that has happened is the self-sufficiency within the manufacturing sector. So a lot of manufacturing has moved back to the US, especially with the conflict with China. And I think that's kind of intentional. And so, with innovation, with the nature of what the US has, I think it's easy to write off the US competitiveness in the global economy and the potential growth rates. But the US has continued to do better than expected. So I'm not going to say that the US will be the biggest economy forever. That clearly isn't going to happen just from maths. And demographics is against both China and the US, but I would not write off the US too quickly. And that's the only thing that is kind of anti-consensus for me. I think we need to wrap up soon, but we have a couple more questions. Okay, these are difficult questions. What do you think will happen in the short term to equities in US dollar if the coming US stimulus falls short? For example, $500 billion instead of 1 trillion. Is that enough for elections? And then there's a comment about don't forget farmland as an asset class, maybe. Okay, that's an interesting topic. Is there a case for bonds given a flattish rock bottom interest rates we already at? Do you want to take any of these questions, FH, or do you want me to answer any of those that are interesting to you
I think
while
the
I
bond
read
was
out the
pretty
questions?
interesting.
Yeah.
I have pretty strong views on bonds, and I just don't think bonds are going to be a good. Okay, I think maybe bonds could be a good investment with a 12-month horizon, but any longer than that, if you're looking maybe 3 years or more out, I think at this kind of price, at this kind of use, bonds are just going to be a bad investment. I think we talked about how inflation is going to be possibly running hot in the coming years, right? So with bonds yielding maybe 1 or 2%, that's you could be making decent nominal use, but once you adjust those use for inflation, I think bonds are going to be a poor investment. That's my view.
Okay. My final question on STI versus S&P. Any thoughts?
The thing about the S&P is that it's 24% weighted to FANG stocks right now. So whereas the STI, it's almost purely old world economies, right? Like banks, real estate players. So it's not a fair comparison anymore because you're basically comparing new world versus old world. New world has done really well the past 6 months, but I do have my doubts on how much longer this tech rally can continue, and I do expect that at some point, old world economies, old world industries, they will stage a comeback. So
Oh, so you're making a bold prediction that value may return.
maybe not in a short term,
No.
but I think mid to longer term, I do think that will happen.
Okay, great. And so just on those topics, I think we need to wrap up. So thank you so much for your questions. But, in bonds play their part. I think, when you do asset allocation, bonds will continue to play their part. I showed you charts of even if interest rates fall into negative territory, you can actually still make money from bonds. And bond if you are concerned about financial markets and what the markets will do in the future, then obviously I think bonds will play a much more defensive part in that scenario. So although the volatility of bonds recently was very high, what the Fed backstop did was not only help the equity market, but it really set the floor for bonds. And we've seen a very powerful rally in bonds over time. And so I'm not necessarily bearish bonds. I think there's pockets within the bond sphere space that I think you should definitely look to. And if you want to have a balanced portfolio, then you should definitely have a certain portion to bonds so that it will, manage, the diversification benefits and manage the volatility of returns. So risk-adjusted returns, I think, with bonds is always going to be better with the benefits of diversification. But with that, there is a concern because there's so many, such a big fall in interest rates. And so I'm gonna end the day with a plug for Endowus Cash Smart because it's a product that we developed because customers really needed it. Bank deposits have fallen to virtually zero. Even FD deposits. My friend who runs a company had a $10 million fixed deposit with a certain bank. He was getting 0.65%. And then they came back and said, oh, we can only offer you 0.13%. But even worse than that, he said, the bank only wanted to take 4 million. He had to take 6 million elsewhere. Say, we don't want your money. So obviously, banks don't have the flush with liquidity. Overnight borrowing is zero, and they have nowhere to lend. So the bank deposit rates are not going to rebound anytime soon, in my view. And yet we have cash, either because we have short-term liquidity needs, emergency money, or we want to save money so that we can invest, or we can we're concerned about markets, so we want to hold some cash. And for those clients and short-term liquidity needs, and for corporates and small enterprise businesses who are suffering from this low yield environment, we created a product that will get you up to 2% yield. The safer version, we have enhanced and core. The core product gets you somewhere close to one, which is which is great because you can't find anything that's safe that yields anything like that. And it can be used for both your cash savings and also for SRS. So SRS only gives you 0.05% yield. If you just leave it in cash, you can invest it, but I think it's great to put that into these Endowus Cash Smart portfolios. There's daily accrual of interest, no lockups, unlike fixed deposits, unlimited transfers, and our tailored no transaction fees, 100% trailer fee rebate. So I do want to give a quick plug to Endowus Cash Smart, and you can use it on the Endowus platform with your investments in a seamless way. And Endowus really is about focusing on what you can control as an investor. So control your career, control your asset allocation and your investment costs. We do shy away from like making too many trading or speculating activities. We cannot predict the economy or the market. Obviously, there are certain individual stocks that maybe you can invest like FH does. But for most investors, I think doing a passive investing regular savings plan is the way to go. And in the world of Endowus, your goals are precisely defined. You have a process for achieving your goals, and you have access to experts and strategies that are unique to us and products to achieve your goals. So with that, announcement about next week's webinar, and it leaves me to thank Financial Horse for joining us, for sharing your wisdom and your experiences and your wonderful knowledge. And thank you everybody for joining us today and for all your questions. Can I get Financial Horse to say goodbye and final words?
No problem. Thanks for having us on, Sam, and really enjoyed this conversation with you.
Fantastic. Thank you so much again for joining us. And maybe we can do this again on another interesting topic later on.
Yeah,
Yeah.
absolutely. Sounds good.
Okay. Great having you. Thank you, everybody. Have a good evening and stay safe.
Thank you.